This is PNC Roundtable.
Hello, this is Ric DeVore, Regional President for PNC Bank, and thank you for listening to PNC Roundtable. It's on this show that we tackle some of the region's tough issues with people who make a difference.
Now here's the PNC Roundtable.
Welcome into the PNC Roundtable. Hi, this is Paul W. Smith, coming to you from Geneva, Switzerland, and back in our studios in the Golden Tower of the Fisher Building, our co-host, the Regional President, Ric DeVore of PNC. And nice to have you holding down the fort, Ric, while we're taking care of business in Geneva.
Well, it's good to be in this sacred room here, Paul, but I think I'd rather be with you right now. At least we can get a 30-degree temperature swing or something. Yeah,
it would be warmer outside if you were here with me, but it would be colder inside if I were there with you in the studio. We're happy to welcome back really kind of a regular guest now. We always look forward to time with Stuart G. Hoffman, Senior Vice President, Chief Economist, the PNC Financial Services Group. Stuart, nice to have you back in town.
Glad to be back, and nice to hear that you're off in a great place doing good things, and but still we can get together and do this anyway.
Absolutely right, and at an especially important time. We, of course, know that this industry, like so many now, are absolutely global. And we're happy to say that with all of the bad times they've had in Europe, there is some light at the end of the tunnel, and it isn't a speeding train coming right at us. And the reality is, Stuart, as you've taught us in the past, what happens around the world does affect us back home.
That's absolutely right. We were, Ric and I were just talking that the outlook for Europe is a lot more promising from several years of recession, turning the corner in the latter half of last year. And yes, our view is for the next couple of years, not full speed ahead by any means in Europe, but growth of maybe 1 to 1.5%, better in the northern part of Europe than in the southern part of Europe, but still a big improvement, which is positive for the U.S. economy, because 1 out of every $5 of exports out of the U.S. go to Europe.
And that's, in fact, precisely why we're here together on the PNC Roundtable today. It's our 2014 economic forecast. And what Stuart Hoffman does so well, better than most, in the PNC Financial Services Group, is takes a look at the entire global picture. And from that, close to home and far away, he can give us a feel for what the outlook for the U.S. economy is. In fact, I'm going to ask you flat out, Stu, the outlook, jobs, unemployment rate in 2014, the U.S. economy overall.
Well, I'll tell you flat out, we're looking for a better year this year. Now, of course, this weather that we've all been dealing with across the Midwest and Northeast is held back the rate of growth in these first couple months of the year, but if we ever get back to seasonal temperatures, and eventually we will, we'll think we'll pick up for some lost time. So compared to the last several years where economic growth was a little below trend in the U.S., we're forecasting this year it'll be above trend, and that's about 3%. Yes, that should bring the unemployment rate down closer to 6% by the end of the year, and we hope and expect that about 2.5 million people will get jobs over the course of this year as the auto industry does better, the housing industry, exports around the world, the energy industry in the U.S., and frankly, less interference out of Washington, D.C., no sequester, no additional tax hikes, and maybe some recent policies of passing a budget and passing a debt ceiling mean that American businessmen don't have to be watching Washington, D.C. with such a wary eye.
Well, Stuart, with the fact that we're here at the Geneva Motor Show and the fact that you mentioned auto sales and you mentioned the bitter cold temperatures, which put the kibosh on all businesses, people weren't going out to buy anything, let alone cars. What is your outlook for auto sales for 2014?
Yeah, we're forecasting, the data just came out last night for February, was 15.4 million, January's 15.2, so here we are running in the low 15s. But we think when the year is out, we'll have sold to the U.S. industry will have sold close to 16 million cars. So clearly some time to make up for, and I think the bitter cold in a large part of the country does explain the slow start. But yes, our forecast after about 15.4 million in sales all of last year, looking for an increase of about 4 to 5% up to almost 16 million. And that means some catching up to do, given we know the first 2 months of the year were well below that.
You were about at 16 before, right? So,
yeah, we've been at 15.9.
Yeah.
You know, in round numbers, 16 million, and you can do the math. If you got 15.3 for the first 2 months of the year, for us to get to 16 million, the rest of the year's got to average a little better than that, and we think it will.
And what about the gas that we're going to put in most of those cars? There'll be more and more diesels, but what about the gas? What are you looking for gas prices for 2014?
Yeah, Paul, we talked about it. Actually, the outlook's the same it's been the last couple of years. I can remember being here 2 years ago, a little later in the year, around probably April, when gas prices were pushing $4 a gallon national average. Get that from AAA. And people were worried about $5, and I said, forget about it. It's not going to happen. And it didn't. And last year, as we always know, gas prices peak usually between Easter and Memorial Day. Right now, they're around $3.50 national average, of course, higher in some states and lower in others. We think we may get close to $4 a gallon again in the next 3 or 4 months before it peaks before Memorial Day, and then go right back down in the latter half of the year, probably back down below $3.50 a gallon. So for the year as a whole, gasoline prices peak in the spring like they always do, bottom out in the winter like they always do, and average probably about $3.75 over the course of the year. And frankly, that would be the same it averaged in 2013 and 2012.
Stuart G. Hoffman with us, Senior Vice President, Chief Economist, the PNC Financial Services Group. It's our annual 2014 economic forecast, and it's kind of uncanny. Our regional president, Ric DeVore, co-host. It's kind of uncanny, Rick, how accurate Stuart has been through the years.
No, it really has. And, I think a lot of us make fun of economists and weather people, but the fact of the matter is...
No. We make fun of Stuart. We don't make fun of all.
I'm just kidding.
I want you to know I'm one of the least inaccurate economic forecasters in the industry.
But it is uncanny how accurate, he has been. I think that's one of the reasons why, he's so often quoted. And one of the things that on the way over here we were talking about is trying to get a feel from you. What's your sense, the mood there, compared to, say, last year and maybe 2 years prior? I know it's not happy days are here again in Europe, but are you sensing a little shift absent the Ukraine conversations?
Well, the Ukraine, unfortunately, the Ukraine situation, which changes by the day and seems to get worse by the day, is certainly on everybody's mind. But that aside, and remove that best you can, there's absolutely a feeling that people are starting to see light at the end of the tunnel. And as we like to point out, it is not the proverbial speeding train coming at us. It's truly light at the end of the tunnel, where when we couldn't see any growth for the last 7-8 years, there's even a little growth being talked about. So it is much more positive, and certainly selfishly for our companies, Ford Motor Company, General Motors, and even Fiat Chrysler, it will be very helpful if their European units can start to make money and stop hemorrhaging money.
And I was listening with a lot of interest this morning about Opel, and it sounds like with GM feels like they've turned the corner with that. So that's promising. We haven't had that conversation since I've been back in Michigan 4 years ago.
Right.
So it's that was promising as well.
I think they had to make a decision. I think they had to say, are we going to compete with ourselves, or let Opel, the brand that's here and that we've got a lot of money committed to and invested in, let's let it do well by not sending in a Chevrolet to compete with it.
Right.
I mean, I think that's, Stuart, I think that's the way they're thinking about that and the way they're looking at that. Do you agree?
Yeah, I do agree. I mean, I'm not, admit, not the expert on the individual companies and their individual strategies, but certainly not competing against yourself in any market makes sense. And, so that's what you're telling me they're doing. It seems to make good economic sense not to be robbing Peter to pay Paul within the same company.
What's a word we don't hear about very much anymore? I grew up hearing it a lot more often. Inflation. What's the outlook for inflation in 2014? Well,
it still looks pretty benign, Paul. Inflation's actually running below the Fed's target. Janet Yellen took over for Ben Bernanke as the chair of the Fed. She says, call me chair, not chairman or chairwoman. I know
Really?
Janet well. I think she's an excellent choice, the best person for the job, and I was rooting for her to get it. She's spoken now a couple of times, and I'd certainly paraphrase her as saying, meet the new boss, same as the old boss. She's going to be a lot like Ben Bernanke and carry on those policies, and that should be, I think, fairly good for the market. So inflation target for the Fed is 2%. Inflation in the U.S. has been running below that, and even lower in Europe. Europe inflation is under 1%. Mario Draghi, the head of the European Central Bank, is trying to prevent inflation from getting too low, getting closer to deflation. So in the U.S., 1.5%. We think over the next couple of years, the Fed will get it up to 2%. Their target. It's a reason why we think interest rates, not this year, but in the next 2 or 3 years, also have to move up because they're below inflation. But you're right, we don't talk a lot about inflation because there isn't a lot of inflation in the global economy in the U.S. Inflation these days is sort of isolated to Brazil, India, a few other developing economies, but throughout Europe and throughout Asia and throughout North America, inflation is near the bottom of our list of worries.
I'm just wondering, Stuart, and you've been around for it all, has that position changed greatly since we used to call Alan Greenspan the Emperor?
Called him the maestro, and he's still around.
He was everything.
He was everything. Emperor,
He was everything.
He was the deity. Certainly, before him, Paul Volcker, going way back, since you said I've been around for it all. I wasn't around 100 years ago when the Fed was started, so I'm not quite that long in the tooth. But Paul Volcker really was the one who slayed the inflation dragon in the 70s, late 70s and early 80s, and then Volcker was in, and Bernanke, Greenspan, I meant to say, came in there and kind of kept it tame, and then Bernanke took over for him 8 years ago, and you're right, inflation was not much of an issue. So it's dramatically different than it was 20 or 30 years ago, and that's true in Europe, it's true in the U.S., and true in most places around the world. Inflation has not been the global boogeyman that it was in the 70s and the 80s in the last 20 years.
But is that, again, with your experience and just shy of 100 years experience, is that just destined to come back again? Are we going to one day at least have that as the bugaboo it once was?
I don't think it's our destiny or any foregone conclusion. People worry that the Federal Reserve under Bernanke and now Yellen have put a lot of money in the monetary system, and it's sort of been sitting there idling. Hasn't reached the ignition, and they worry that over the next 2, 3, 4 years there could be a comeback of inflation. I'm less concerned about that. I think the Fed will rise to the occasion, that they'll have to make some tough decisions over the next several years. Janet's term will be 4 years if she's not reappointed by who's president at that point. So no, I do not think inflation is the U.S. destiny or a foregone conclusion. But like anything, sometimes you have to work hard to influence your own destiny. And I think the Federal Reserve and the American worker, by being more productive, and it would be sure helpful if we got some changes at the federal government to reduce some of the unfunded entitlements that we have, particularly in the next decade. You can put those together along with this energy revolution we're having in the U.S. economy and say, no, there's no reason that much faster inflation has to be the destiny of the U.S. over the next decade or two.
All right, let me ask you, Rick, before we go to his philosophical take on this, from the front line, from the trenches there at PNC, what are you seeing or sensing, I guess, for the outlook for housing sales and prices for this year, 2014?
Well, we're seeing definitely an uptick. As you know, Paul, in some pocket markets, there's a huge shortage of supply. It's not across the board in all of the housing prices in Metro Detroit, but in some of the upper end areas, I think I would call it severe shortage. And I'm hoping that new construction should pick up and follow that. Right now it's more of a scattered lot kind of situation versus large tracts of land, but you're starting to see some of that. So we think there's a definite uptick in that. And, I think, getting back to one of the things that we were just talking about, Stuart was talking about, I think that there's now going to be, our sense is in 14, more of a look towards home versus to Washington. I mean, there was just so much going on in Washington before. I think it was distracting to the small business person, the mid-market person as well. And so we're hoping that translates into more borrowing. And I'll tell you right now, and I've said it a few times this year, it's a great time to be a borrower. You have a lot of banks that have the willingness to lend. You also have a lot of pent-up money in both the private equity and the venture side. So there's a lot of money that's been sitting on the sidelines. And so we're hoping all that translates into an uptick.
All right. And then what is your take, Stuart?
Yeah, no, from a little broader national perspective, we think housing is on the mend. Still a long way to go, well below demographic trends. For this year, we're thinking nationwide home sales, new and existing, and home starts will be up at least 5%, over 1 million for new home starts. But guess what? Demographically, we ought to be doing 1.2 million or 1.3 million. So this is not just this year. This could be the rest of this decade. We think home prices will be up. Yeah, they may be up faster in Miami or Atlanta or Vegas, where they were down 50% than they will be in most other parts of the country. But we think 4 or 5% increase on average. So yes, we think the housing market is good. Will get better. Mortgage rates right now, a 30-year fixed mortgage rate, actually come down a little bit over the winter months, as it typically does, probably down around 4.25% to 4.5%. That is higher than it was a year ago, and maybe this spring will be at 4.5%. But it's still we think a very reasonable rate. It's no higher than the house prices are probably rising, and mortgage money will be more readily available. So yes, we think the income and the employment and the availability of mortgages and a rate of 4.5% or even 5% is by no means a showstopper for an improving housing market this year, and I would say over the next several years, maybe the rest of this decade.
Along with Regional President of PNC, Ric DeVore, we've got Stuart G. Hoffman with us. He's Senior Vice President and Chief Economist for the PNC Financial Services Group, serves as the principal spokesperson on all economic issues for PNC. And Stuart has been recognized a number of times as the most accurate forecaster by Business Week and by others along the way. In fact, he was named one of the top forecasters in the Wall Street Journal economic survey a few years, and joins us at least once a year with what we call the economic forecast. And in that, we talk about a lot of different things that we've already covered, and we add to that now, Stuart, your outlook for the stock market this year.
Well, we mentioned a little earlier Ukraine and the uncertainties that caused. January, before Ukraine, we had a kind of a weak month for the stock market. Let's remember, this is after a 30% rise last year. So, here we are today in the U.S. with the market basically getting back all of what it gave up yesterday. As you mentioned earlier, the situation in Ukraine seems to change hour by hour, day by day. So looking through some of the short-run gyrations, things that affect the market for a month or for a couple of days, we think the stock market's headed up. We think we'll walk on 30%, knock on wood, but 5, 6, 7%. So we've been telling our wealth management clients, we told them that in January, don't be spooked by this decline in the stock market. At a minimum, don't sell into it and don't get sort of bluffed out. If you have a little cash, you might want to consider doing some buying. And frankly, if the market falls another 5, 6, 7% for any variety of reasons, we'll be buying more. We'll want to buy down. We'll view that as a sale, a 5% off sale, probably no more than 10%. And our view is, if I'm right about the economy, as we talked about earlier, doing better, and earnings going up and interest rates still staying relatively low, we think the stock market is a much better place to be than the bond market, or just staying in cash where you earn virtually nothing. So I'm not going to give you an exact number, but I'll tell you that we think that we'll be higher than we were when the January 2nd began, which means we'll be higher than we are today because we're a little bit below that, but 5 or 7%, not 20 or 30%, and that'd still be pretty good for 2 years in a row.
Absolutely right. And what about those interest rates for 2014?
Well, as I said, Janet Yellen has made it clear that the Fed is not going to raise short-term interest rates. They're virtually zero. They've been that way since 2008. We don't think that changes this year. Maybe next year, Paul, when I come back and we're talking and you ask me that question, I might say over the course of 2015, towards the end of that year, you may actually start to see some movement up in interest rates. But, basically what you see now is what you're going to get the rest of this year. Little longer rates, like I mentioned, mortgage rates or treasury bond or municipal rates, probably edge up a little this year. 10-year treasury today, use that as a benchmark, is around 2.65%. And we think probably it ends the year above 3%, maybe 3.25%. So some drift up in a little longer term rates. That's why bonds don't do as well as stocks. But frankly, for those investors in money markets and CDs that frankly hate those zero interest rates, unfortunately, I got to tell you, you're not going to see any improvement in that this year, and maybe not till much later next year.
And you've had to make plans for that, Ric DeVore, because CDs, for example, used to be a big part of a bank's business.
Yeah, and you're right. The real rates that we're paying, I think Stuart referenced almost nothing, but it's a tick above nothing, but not much. And you're right. That's been a real issue. And I will say though, except on the municipal bond side, there's unfortunately still uncertainty because of, let's face it, the Detroit bankruptcy. So you're seeing kind of a premium that the municipalities are paying, and especially the ones that are in southeast Michigan. And I think it has to do with, nothing more than uncertainty as to some of the precedents that are being set by, this bankruptcy. So if you're running a municipality, especially in southeast Michigan, you're going to say, I am feeling an uptick, but I would offer to you that's not really normal market conditions.
Yeah, actually the municipal market did worse than other bond markets last year. Not only Detroit, but Puerto Rico has not done well and is very close to, maybe needing a bailout. So that weighed heavily on the market that's dominated by individual investors, and sometimes they get a little spooked by those events beyond what's necessary. We've actually seen in the last 3 or 4 months the municipal market outperform. So it may well be true in South, Michigan or and certainly Puerto Rico, but we've seen a nice improvement. So amongst the bonds, while as I mentioned, PNC is not that fond of the bond market in total, we still like municipal bonds because we think there are values and there are the tax advantages, and clearly within the bonds that we're holding for the right types of individuals that are taxable, we think municipal bonds probably represent a pretty good value in a broad, diversified portfolio.
Go ahead.
Well, I was just going to say, in our mix, I believe, Paul, Stuart will correct me if I'm wrong, but I think is, 65-35%?
Yeah, 65 would be, for a, kind of a straw man or woman investor that wants to take some risk, but not all. We recommend 65% of their portfolio in stocks and 35% of their portfolio in fixed income, whether it's treasury bonds or CDs or municipal bonds. We haven't changed that in the last couple of years, but as I say, we've become a little more defensive in the types of bonds that we would recommend our clients own, and we've definitely seen some opportunity in municipal bonds and still like that area.
Outlook for the federal deficit for this year, Stuart?
Well, it's coming down. It's going to come down the next couple of years. Congressional Budget Office, nonpartisan, just came out with a report. They're forecasting a drop to under $500 billion. I actually think they're being a little too conservative. I think it'll drop even maybe to $400 billion. I know that sounds like a big number. Anything that has a billion at the end of it has a big number, but
a billion here, a billion there. You're starting to talk about real money.
You and I could live comfortably on $400 billion a year, and maybe even the rest of our family. But for the nation as a whole, when you have a $17 trillion economy, $400 billion is 3% or so of or less than 3% of our economy. 2 years ago was $1 trillion, clearly unsustainable. So near term, the budget deficit is getting better. It's not going to go into surplus, but it's coming down in dollars and a share of our economy. Unfortunately, that's a temporary reprieve before the end of this decade, unless we do something on entitlements, and we'll have to see what happens with health care costs, Social Security, other entitlements. If we don't do something, the deficit's going to start headed back up again by about 2017 or 2018, and in the 2020s could be right back up there in the $1 trillion range, which is, of course, a major negative for the economy. So we have a window of opportunity, we meaning our elected representatives in Washington over the next 2-3 years. If they twiddle their thumbs and don't make any tough decisions and get lulled into complacency, yeah, we'll have 2 or 3 good years on the deficit. That'll help the economy. And then before the end of this decade, it'll be getting a lot worse again. And we're going to sit there and say, why the hell did we fiddle when we had an opportunity in the middle part of this decade to actually make some tough but necessary long-run decisions? We'll see who we elect, and we'll get what we deserve from them.
That's so true. We'll get what we deserve from those we elect. Before we let you go, Stuart, we're going to take advantage of your expertise on a local basis, along with Regional President Ric DeVore and me. I'm not going to make this up. Obviously, I'm very, very concerned about specifically the Detroit metropolitan area in 2014. It's great to talk about the world and about the country, but right here, what's your outlook for job growth and unemployment in Detroit?
Yeah, in the Detroit metro area, to give you a few facts, last year, and the data will actually get revised a little later this month, but as it stands now, you created about 15,000 jobs in the Detroit metro area, which is not quite 1%, because your workforce is about 1.7 million people, down from 2 million, in 07 before the Great Recession and the retrenchment in the auto industry. For this year, we're forecasting you'll do a little better than that. We think maybe 15 or 20,000 jobs over the course of this year, which would be a little better than 1%. That's not quite the pace that we think at the national level. We think the unemployment rate, which in Detroit, of course, peaked at 16%, is down to close to 9%, and the latest month of December was 8.9, but that's, call it 9% in round numbers. We think by the end of this year, it'll be closer to 8%. That'll still be above the national number, but somewhat closing the gap. So 15 to 20,000 jobs and an unemployment rate that drops from somewhere around 9% to in the low 8%. We think your housing market will continue to improve, as we referred to earlier at the national level. We think home prices in Detroit will probably be up by at least as much as the national level, although still well below the peak in 06. So yes, I think if with the auto industry doing better and manufacturing in general, and if we're right about the national economy growing a little faster this year, I think you will see that reflected in continued improvement and maybe even a little better or faster pace of improvement in the Detroit metro area economy.
Yeah, well, that's good news, and especially that outlook for housing sales and prices in the Detroit metro area for this year, for 2014. And in fact, I'll give you the last word, Ric DeVore, on reiterating again that this happens to be, at this moment, a great time to be a borrower.
No, it really does. I mean, if you look at one of the things that sometimes frustrates me as a banker is people seem to fixate sometimes on the spread and not the real rate. And, these rates by historic standards are outstanding. And if you couple that with, I was talking about this Washington focus, but I'm really wondering if people now are going to start making some investments in their companies, not just buying companies, but one of the things we were talking about earlier, Paul, is the average age of equipment out there is practically double what it was in 1980. In other words, it's about 18.9 years old versus 10 years old back in 1980. At some point, not addressing that issue catches up to you. So we're hoping that translates into more leasing and more acquisition, which I think would also translate into more jobs. I temper that a little bit with this thing that we talk about, Paul, and you and I have talked about this repeatedly, and that is this still somewhat mismatch of job needs and workers. And
right.
We continue to hear that. I think there's a little bit of I think some of the college graduates are still a little timid about taking a leap into the auto industries or tier 1 or tier 2 suppliers, and so I think we still have this mismatch. And I think as long as that is present, and my thought there is that we're not going to probably get anything on anything to do with immigration this year, and it being an election year. I think that's still going to hold us down just a tad bit, but I'm hopeful.
Stuart, are you seeing that around the country, since you cover the whole nation, the same sort of a problem where we're not able to have the workers available with the proper training and education to take the jobs that are available?
Yes, that is maybe not nationwide, but it certainly covers more than the auto industry. It's certainly true in the energy industry. It's true in some of the medical field, certainly engineering, even CPAs. And then you think about all the people who are underemployed at college degrees, but maybe not in those right fields. So in the Federal Reserve, when they do this they call it the Beige Book, it's a monthly roundup of anecdotal information from around the country that they publish. And a number of the regions in the economy in the Southwest, here in the Midwest, say that whatever the industry is, there are jobs but not available qualified applicants, at least not in the eyes of the would-be employers. So yes, it is nationwide. It is a juxtaposition with this unemployment rate and underemployment rate that we would have jobs that are still going begging for applicants. And of course the answer is the education, and as Rick said, maybe perhaps partly immigration, and also realizing that maybe going to college as opposed to a technical skill is not the best choice. And if you do go to college, maybe having a little more of a career focus in what you major in and specialize in might at least be a better choice for you as you think about your career after college. And science, engineering, accounting, medical care, biotechnology, those are areas where the job prospects are going to be greater than in many other college degrees. Although
Stuart?
I'm starting to sound like my grandfather.
Stuart, we always appreciate you visiting with us. Glad you brought your crystal ball along. Stuart G. Hoffman, Senior Vice President, Chief Economist, the PNC Financial Services Group. Final word from you, Rick.
Oh, Paul, we just want to make sure you have a good time out there, and I'm assuming Kim's with you.
Yes, indeed.
Well, say hi.
Helping out.
Say hi for me, and keep Link in line is my last word. I know it's going to be full-time job, but
that is a full-time, almost impossible job. I'll only say I'll do my best.
Well, we look forward to seeing you when you get back.
Very good, Stuart. To G. Hoffman, our special guest, Senior Vice President, Chief Economist, PNC Financial Services Group, and for PNC Regional President Ric DeVore, regards, Paul W. Smith.